Now, if you structure it the right way, you can actually accomplish a lot of great things. And that's what the Rockefellers did. They structured their life insurance in just the right way so that the death benefit is pretty low, the cash value accumulation is pretty high. Pillar number 2 is what you need to really focus on first and foremost, the concept of protection coming first. That is the thing we need to make sure that we're doing and engaging in. There are a few different things that the Rockefeller family has done and continues to do that focuses on this protection coming first ecosystem. The first is the strategic use of permanent life insurance inside of the trust ecosystem. The Rockefellers do utilize this concept of permanent life insurance inside of the trust. And they do that because of the nature of what life insurance is. So life insurance is not an investment alternative. It is a risk mitigation tool. This is why I get into some online debates, if you will, with insurance agents who post on social media, because oftentimes they're talking about life insurance being a great tool for wealth creation. Life insurance is a great tool for wealth preservation. You have a lot of individuals out in the ecosystem selling things like IUL, like Index Universal Life. And I fundamentally have a challenge with that approach in this methodology, because oftentimes those types of life insurance policies are being sold and structured incorrectly with regard to this particular goal. It doesn't mean that you could not use certain types of life insurance policies for this outcome. It's just the vast majority of them that I've personally seen are not structured the correct way. Life insurance, imagine that it is an account, right? And every time you make a premium payment, it divides that premium payment into 2 separate accounts within an overall account. Account A is the account that handles all of the expenses that are associated with the life insurance itself, right? The actual risk expenses, like God forbid if you died, you have to have money in order to pay out claims, if you will, for that policy. The carrying cost of the operations, if you will, of the life insurance company that's issuing the policy, right? All of the expenses that are associated with the life insurance, a part of your premium payment goes toward that. Now, if you have temporary insurance or term insurance, 100% of your premium goes towards those expenses, right? There's nothing left over, it all goes towards that. In a permanent policy, whole life, variable life, universal life, variable universal life, index universal life, those are all what are referred to as permanent life insurance policies. And the difference between a term policy and a permanent policy is there's a second account into which your dollars go. And that is some form of a cash value account. Now, I personally dislike the use of the phrase cash value because I believe it sort of makes the buyer of the insurance or the individual who's considering purchasing insurance believe too heavily in the fact that that is their money. The cash value is just another account that is set up by the insurance company. And quite frankly, the insurance company is the one who owns that cash value account, unless you do something very specific to pull that specific dollar out of the insurance contract. There's a certain way you can access the cash value directly, but doing so actually has the potential of voiding your insurance agreement, right? So you no longer have life insurance. So I don't like the use of the term cash value, but that is literally what it's called, so that's what I'm calling it, right? But I want you to understand something, that is an account that is owned by the life insurance company. Again, you have access to it for different reasons. You can leverage it in different ways. But if you think of it as your money, I think you're already down the wrong path with regard to this process. But why is this important? Well, life insurance policies have a very specific provision under the Internal Revenue Code that govern them. And if they are structured in the right way, the money that goes into that cash value portion of the insurance contract can grow. And it could grow based on a variety of different things. It could be the underlying performance, if you will, of the insurance company and how they choose to invest the dollars. It could be the insurance company sets it up in such a way that gives you an option with regard to how those dollars get invested, based on a certain list, if you will, of investment alternatives within that agreement. Regardless, as long as it's structured the right way, and you have not done things to otherwise knock you out of this particular classification under the Internal Revenue Code, as that cash value grows, you do not pay any income tax on it. That's hugely powerful, right? It's a tax deferral mechanism. And so long as the money stays in that insurance agreement and never really gets withdrawn by you truly, then there's no taxes on it ever, because the death benefit proceeds of life insurance also are not income taxable to the beneficiary. So a life insurance contract has a lot of tax benefits that go along with it. And here's the interesting thing that the Rockefellers really leveraged to the nines, right? They definitely did it like awesome. They structured their life insurance in such a way where the death benefit was not necessarily as high as it could have been, but the cash value accumulation within the policy was. Now, there always needs to be something like a difference, right? Your cash value cannot equal your life insurance, because then the IRS actually treats that as a different entity. They don't treat it like life insurance anymore. They treat it as something called a modified endowment contract. There needs to be maintained a corridor of insurance risk. It's called the corridor of insurance specifically. And so long as there is an amount, a difference between the amount of cash value that's in the policy and what the ultimate death benefit is, as long as there's a difference here, a certain corridor, then there's not any income taxation on the growth, if you will, of that cash value account. But what an insurance company will permit many to do is they will issue you a loan guaranteed by the contract, right? So you're essentially encumbering the contract and getting a loan from the insurance company. And now what a lot of insurance agents will do is they will describe this as you borrowing money from yourself. And that's just not true. I understand the sales technique behind it, and I understand why insurance agents talk about it that way, but it's not your money. You're not actually borrowing your money. You're borrowing money from the insurance company. Now, if you structure it the right way, you can actually accomplish a lot of great things. And that's what the Rockefellers did. They structured their life insurance in just the right way so that the death benefit is pretty low, the cash value accumulation is pretty high, which means the cost of insurance, the portion of your premiums that get paid every period, whether it's monthly, quarterly, annually, whatever your premium payment period is, the portion of your insurance premiums that's going towards the cash value account is much higher, and the portion that's going towards the expenses associated with the insurance contract is much lower, right? That just means more of your premium payment is going towards the accumulation of a cash value account against which you can leverage a loan from the insurance company, meaning you can borrow money. And the secret ingredient to loaning or borrowing money is that borrowed dollars are not taxed to you. So you can put money into an insurance contract, allow the cash value account to accumulate over time, and given enough time, you may acquire or accumulate, if you will, a large amount of cash value. And the insurance company may permit you a certain percentage, if you will, of that cash value's worth. They may give you a loan equivalent to that, right? So whatever that particular insurance company's policies are with regard to their loans. Now, protection coming first is critical, because what happens was the Rockefellers understood that if we put money into an insurance contract, at some point in the future, not only does it create a protection for my ability to generate income, right? Because if I die, my insurance policy will pay off a death benefit that is not taxable to the recipient, right? It's an income tax-free situation. So it can replace, if you will, my individual ability to generate income, right? To help my family on a forward-going basis. But while I'm alive, I could also borrow from that insurance company policy. And that borrowed dollar doesn't get income tax to me either. Maybe I pay that back, maybe I don't. But if there's a scenario where I do not pay and I still have an outstanding loan from the insurance company, my death benefit is reduced by the amount of outstanding loan, which is not taxable. That's why this is so powerful, right? It reduces our exposure to the tax ecosystem that erodes the dollars that we're working hard to create. And that's why the Rockefellers leverage this. The other thing is that there's no qualification to borrowing the money, right? You don't have to qualify to a lender to borrow the money. It's just by contract, you have the ability to borrow based on whatever the cash value is that's accumulated within the policy. So as long as you're paying your premiums and the policy is performing, it gives you the ability to have access to capital. which you could use that money for anything you wanted to. You could go use that money to buy a business. You could use that money to buy real estate. You could use that money to invest in your existing business to create another stream of income or to support your business during a growth phase. I mean, there's lots of ways you can use this. Again, I've been called like an anti-insurance person by a lot of insurance agents. It's not because I'm actually anti-insurance at all, right? I actually think insurance is a great tool. I just think that the way a lot of agents sell it is as a tool that it isn't. It is not an investment alternative. It is specifically a risk mitigation tool. It has other benefits, right? And if you structure it the right way, you get those benefits. But here's the kicker. Like the way I just described structuring it, the least amount of death benefit with the maximum amount of cash value, wouldn't it be interesting to know that that actually results in some of the lowest commissions to the insurance agents that there are? Listen, I'm an unapologetic capitalist, but it's interesting to note that the people who are selling it to you are not necessarily incentivized financially to sell it to you the right way. Now, there are a number of actually good, ethical, good insurance agents out there that do structure things the right way. But this is why I'm spending so much time on this aspect of it, because this is critical to the Rockefeller method. But if you do it the wrong way, you can get a really bad result, right? Because you can get a policy that has too high of a death benefit to too low of a cash value accumulation, which just means it will be very difficult or a very long time from which you'll be in a position from which you could actually borrow against that policy. Not borrow from the policy, right? Because you're not actually taking money out of the policy. You're borrowing money from the insurance company, and they are essentially guaranteeing that loan to you with the policy itself. There's a lot of other nuance on it, and I have an entire video on how life insurance works, and if you haven't seen that, definitely be sure to jump into that video. I have another video on the Rockefeller method specifically, right, and how the Rockefeller method is utilized specifically with regard to insurance concepts, right? So I dive much deeper into that environment. So if you haven't seen that either, go ahead, jump into that. The other thing when it comes to protection is not only do you want to protect your ability to generate income for the family, you also want to protect the assets from all of those enemies at the gate, right? The creditors, the litigants, the opportunists who want a piece of your pie. And the way you do that is through that layered entity structure that I talked about, right? The real wealth matrix is the ideal hierarchy of ownership because it literally incorporates that layered entity structure. Like we use, again, trusts, holding companies, operating companies. Now, it's important to understand that there is nothing in the law that says what a holding company is. That is a term of art. What that means is essentially when I'm saying the words holding company, I'm referring to a business entity that you have created for the purpose of owning other things on your behalf. It could be intellectual property, it could be other businesses. In theory, it could be financial assets. There are lots of different ways to have that structure. An operating company, again, nothing in the law that says what an operating company is. It's a term of art. When I use that phrase, I'm referring to a business entity that you've created to engage in commerce. Right? The buying and or selling of goods and or services with the public. And when you structure things the right way and have this hierarchical ownership structure, it gives us the ability to have both inside-out liability protection along with outside-in liability protection. The other thing we want to make sure is that it is structured in such a way to prevent your wealth journey from being disrupted by things like lawsuits, right? The right infrastructure safeguards against that. Creditors, the right infrastructure safeguards against that. Divorce. The right infrastructure safeguard against that, right? The Rockefellers have a plan in place that incorporate all of those different aspects into the outcome that they're looking to perpetuate, which is generational wealth. So having that right infrastructure makes that a possibility. If you got value from this video, go ahead and click that like button. And if you want to be informed of new videos that could help take your life and your business to the next level, be sure to subscribe and click the notification bell.